Hello and welcome to the Wealth Management Invest podcast. I'm David Bodamer, part of the editorial team at wealthmanagement.com. In this episode, I'm excited to bring on Ben Sayer, who is the Alternative Investments Group Head and Managing Director with MAI Capital Management. Ben, welcome to the podcast.
Thanks, David. Excited to be here. Great to see you again.
Yeah, good to see you. We had a chance to be on a panel together at Wealth Management Edge a couple months ago, which was fantastic. So wanted to continue that conversation on the podcast. So, to get things rolling though, I wanted to, if you could just set the stage for us a bit, talk a bit about MAI Capital and some of your client base, like what kinds of folks that you're serving, and then also talk a little bit about how you got into the role that you're in.
Sure. Yeah. So MAI was founded originally as part of IMG, the sports agency here in Cleveland, Ohio. And so we've officially separated from IMG back in the early 2000s. Unfortunately, after Mark McCormick, the founder of IMG, passed away, a private equity firm purchased IMG. They didn't want SEC oversight, and so they left MAI out of that transaction. Our current executive chairman, Rick Buonocore, purchased the firm back in 2006. And so he has been very busy since that point. When he purchased the firm, we had, a little under $1 billion of assets under management. And today we're north of 30 billion. And so we do still have probably, 25% of our business is serving that core kind of high profile athlete and entertainer. That is a holdover from the IMG days. And then we've also diversified the business and grown the business to serve kind of three main kind of client groups. And so we have the athletes and the entertainers. We have the ultra high net worth multifamily office clients. And then we also have traditional high net worth investors as well. And so creating investment solutions across those three buckets is a bit of a challenge. And each one of those client bases have their own unique needs and problems that they face, but kind of solving those for all of our clients is really the challenge here on the investment team at MAI.
Yeah, so that definitely gives you guys an interesting purview, just given that client mix. So talk about then, your role and how you came to the firm.
Yeah, so I joined MAI back in 2017. I came from PNC Capital Advisors, where I was a product manager working on the PNC branded mutual funds, as well as some of the large institutional sized accounts across numerous investment strategies over there. I really wanted to get closer to, directly making investment decisions instead of working on investment products. And so joining our current CIO, Kurt, and I as kind of the first hire on the alternatives team was a big leap, but really, really excited how that turned out. And so we started just kind of the two of us, and we were supported by our alternative investment committee, which was, 10 plus really experienced advisors from across the firm that had really helped build out the investment capabilities of the firm. And then as we've continued to grow, my roles and responsibilities have grown right alongside the firm. And so today, I view the alternatives team, our challenge and our main goal is to build kind of plug and play alternative investment solutions across three different categories of alternatives. And so we break up the universe into income and low volatility alternatives. So think of things like private credit or market neutral hedge funds in that bucket. Certain flavors of real estate and real estate debt also fall into that category. Then we have growth alternatives, which are traditionally private equity and venture capital, kind of an extension of a client's equity portfolio, just taking on the illiquidity. And then finally, we have real assets, where we put traditional real estate and infrastructure. And so, like I said before, we're really trying to get our clients kind of plug and play exposure across those categories in meaningful ways that can help their kind of achieve their financial goals alongside their financial advisors.
So I find it's an interesting seat that you're in because, in the industry itself, we're in this moment where everyone is suddenly paying attention to alternatives, and there's a lot of new players coming in or a lot of people embracing it. But your view goes back further because I imagine partly because of this function of the client base and those are the kind of people that would have been thinking about alternatives for a longer. So what do you make of the way that the industry is maybe in some ways catching up to stuff that you have been doing?
Yeah. And I mean, that even predates me. And I attribute it a lot to just the entrepreneurial nature of our firm. And I would say, kind of one of our core ethos is don't let structure, don't let paperwork or hassle get in the way of a good investment. And so like one of our longest partnerships dates back to doing a co-invest alongside a firm back in 2011.
Okay, wow.
That firm is actually we were doing alternatives prior to that as well, building our own fund of funds and things of that
Hmm.
nature. But that co-investment really kicked off a relationship where our firm has grown tremendously, and that firm we invest alongside has grown even faster. And it was really, my boss Kurt and I, and our managing partner Rick, just really seeing, hey, the risk return in this investment is really, really great. One, let's do this co-investment, but also we like the way those guys think. Let's go partner up with them on a more meaningful level. And that really kind of kicked off what we've done a lot of, which is when we go structure these partnerships, one, we're looking for long-term partners where it's going to be meaningful for us, it's going to be meaningful for our clients, but hopefully also meaningful for the firm and the capital that we're going to bring to the firm we're partnering with. And so whether we structure that as an internal feeder fund where we're
Hmm.
going to aggregate all of our client capital together so that we can go with one check to the GP and drive some fee savings that we can bring back to the client. Or, some GPs or managers in the space have the capability to take clients as low as $250,000. And if clients can go direct that way, and that's the easiest way to make the investment happen, we'll pursue that avenue. And so, David, just like you said before, I feel like the industry's catching up of how do we solve the administrative burden
Hmm.
of having small check sizes, small tickets go into these investments. How do we manage the liquidity prudently, and how do we kind of make those things in easy bite sizes for a traditional high net worth portfolio?
Yeah, so it sounds like, and correct me if I'm wrong, that like, so you were doing a lot of this stuff basically in house, just like doing this kind of managing of the relationships and all of the administrative work that goes into managing alternatives. But also recently you guys did a partnership with iCapital.
Mm-hmm.
So I guess if you can like contextualize that a bit, like how has the technology or this infrastructure in the industry that's developed, how is, what's your take on that, and how is that kind of interface with like, it seems like an interesting challenge then, taking like, okay, if you've been doing this for a long time and you kind of built your own processes, but then like now you also like are trying to maybe migrate it or work together with someone else to help further that. I don't know if you could just, I'd be curious just to hear about that, if what I'm saying makes sense. Yeah.
No, it totally makes sense, David. And I would say the one big thing, and it goes back to what we were literally just talking about, of how do you make these things scale? And so that was the heart of our partnership with iCapital, was how do we make the processes and the feeder funds that we were building in house, how do we make that scale? As we went from a small sub $1 billion RIA to a $30 billion RIA today. And I don't think around here there are any plans to stop growing. And so how do we make these things scale across new advisors, new acquisitions, and new clients? And so iCapital was, I think, a key solution for us to help that process scale. And so it was, you're sitting here in a desk today thinking, all right, this is a little burdensome today, whether it's filling out paper subdocs on a PDF and printing them out and having them signed, then re-downloading those PDFs and storing them, making sure all the answers are correct, and we got all the pieces and parts in place to get the investment, into the client's account. How are we reporting on it? How are we running tax? How are we running audit? All of those things. And saying, all right, if we're struggling to do this now with the people and places we have today, if we're going to go double in size, how do you do that without more than doubling in size the employees that you have? And so I would say technology is certainly the answer there. And I mean, I think RIAs are probably not on the forefront of technology. It might be a stodgy industry that we're in, but I think iCapital is one of those groups out there that's really bringing the technology to the forefront. First and foremost, just on like what we refer to as pre-trade, right?
Hmm.
Like you identify a fund we want to go into. If we want to build a feeder fund around that to use the size and scale of MAI to pass on
Hmm.
some benefits to our clients, iCapital can help do that with relationships and with technology. So they can help us build that fund. We identify the GP we want to partner with. They'll help us build the fund, and then they'll digitize the subscription documents as well, so that our clients we can just log into the iCapital portal, basically click some drop downs and say, all right, this client wants to make a $250,000 commitment to this fund. They select those buttons. There may be a couple of extra questions that they have to answer, but a bulk of that information is already stored in there and used from other subdocs, and so they can just port that over to a new subdoc instead of having, whether it's me, whether it's one of our advisors or one of our client service specialists, filling out a 75-page PDF that has most of the same questions as the last one did, but they're a little different this time. And so really just coming into the 21st century of using these digital tools is key to our partnership with iCapital. And it helps on the front with filling out the subdocs. It helps on the back end when you're managing that fund. It helps distribute the K1s. It helps distribute the quarterly capital account statements. It helps get all that information into our portfolio accounting systems, so that during those quarterly meetings with clients, you can show the most up-to-date information we have to the clients directly, because that's another challenge on reporting with alternatives.
So basically, you're also able to take all of these legacy things that you've done and bring them into a platform, like bring them into this new platform. So it's like you could, like, you're not just like starting from scratch on new stuff with them. Like you're able to take the legacy stuff and manage it all together now.
Yeah, and not all of it, because
No,
there's some small stub positions and things like that, but that maybe didn't make sense. But yeah, we were able to bring kind of key legacy positions onto the platform to help manage, as well as anything go forward from here that we want to spin up. And so there's obviously been some growing pains and some onboarding pains with any new technology, but it's been really positive so far.
So, and just looking at pivoting a bit, so like the alternative private market, whatever, both of these terms get tossed around kind of interchangeably a lot these days, but there, we had the traditional kind of drawdown structures that have been around. Now we have this sort of these newer kind of evergreen structures that are coming. There's just a huge amount of interest from the asset management side on the wealth side. I basically get inundated with like press releases about new funds, also about the teams they're building, we're hiring a new head of RIA channel. We're hiring a new private wealth. So what does the challenge become on like the diligence side? You're sitting in your seat now, like seeing this increased interest, increased competition, increased kinds of fund structures. Like, it sounds like pretty exciting to me to have to be in that right now, but curious about what your take is.
Yeah, it's super exciting. On one hand, you're like, all right, this should open up new avenues for more of our clients to get exposure to things that are hopefully, positives. And if we're doing our you can kind of basically divide up the diligence challenge, right, to underwriting and understanding and finding really good underlying investments. But then you also now have to understand like the vehicle that you're coming through and any pros and cons of that vehicle. And so, what we see is basically the challenge of these new evergreen structures is that, yes, it's really easy to get exposure to some things that you might find really attractive. But you want to make sure that if you're coming in through an evergreen vehicle, you really want to be cognizant of the price you're coming in at, and then possibly the price you're going to go out at. And then two, if and when there might be hiccups in that liquidity along the way. And right. I think it's really difficult to diligence some of these things because they're first and foremost, they're illiquid. And so you can't snap your fingers and make this magical liquidity transformation of turning an illiquid asset into a liquid one. It took us hundreds of years to build the liquidity we have today in our public markets. And so we're certainly not going to do that with private markets, in the course of a decade. But for us, it really goes on a gradient, right? Like I think there are things like private credit that are fairly easy to value on a quarterly basis. And you're just saying, hey, is this loan impaired or not? If not, it should be traded roughly at par if it's a floating rate loan. Are there differences in credit spreads from when this was underwritten then for versus today, possibly, and that should change the pricing a little bit. But across a well-diversified portfolio, you can get pretty comfortable there. And then moving on to things like real estate, we do have in the country today, like we have a very robust way to value real estate. And you can say from an investment perspective, and at the margins, it may be right or wrong. Like I don't want to make an investment decision based off of simply an appraisal report.
Right.
But if I'm investing in a broad diversified portfolio, you can get a little more comfortable there. But then as you stretch out into the risk spectrum, into things like private equity and venture capital, the price you're paying on those things today and then the price you're going to exit at in the future becomes much, much murkier. And so I think that honestly takes some of the benefits away from some of those asset classes and just makes the evergreen structure much more of a challenge to wrap your arms around, even if you really like the manager who put the structure together and is sourcing those deals. And so if I'm sourcing those deals beside them in a drawdown structure where everybody comes in at the exact same price, they sell that asset 5 years from now, everybody leaves the exact same price. There's a little less onerous on the vehicle diligence, whereas on the evergreen side, it gets a little more challenging.
Yeah, it's been interesting. I think there's increasing amounts of data too about some of these things. I mean, Morningstar's expanded their coverage. There's PitchBook. Some of these folks weren't even doing this stuff a year ago. Now suddenly you have like reports that are looking more at this market. I thought some of Morningstar's analysis, which I think a couple of things jumped out, some like dovetails what you're saying. One was that there seems to be a tremendous amount of momentum around private credit in some of these, both the BDC and the interval fund wrappers, but also the fee structure. Like the report they did was very eye opening and looking at like all these kind of like layers of embedded costs that you're paying. And you still might, like as long as it's performing, you still might get a decent return, but it's just like you're paying pretty significant chunk of, like compared to like, some other things you might be investing in. So I guess if it's like on a net return, you're still okay. You can be okay with that, but it does seem like it's also perhaps a place where there's further a movement here, like maybe more competition. There's fee compression in that space, and these things become better. I don't know.
Yeah. And I mean, it's something we wrestle with all the time, right? Of like, okay, first it starts out where you're providing more access, people rush in, and so it's great. But then the more people rush in, the more capital chasing a given asset class, right? You would just expect, just from a Econ 101 perspective,
Right.
for forward returns to go down.
Right.
And so is part of the illiquidity premium, part is just the complexity premium of the difficulty to access these things. And so that if you remove all those roadblocks, then maybe we get some fee compression too, but also do we get total return compression, and trying to balance that long term is very difficult.
Yeah, it's definitely going to be interesting space to watch, especially, I guess the other thing that we haven't seen, I think, which you also alluded to, is like what happens when there is a liquidity crunch, like when you have a situation where these funds are hitting their redemption gates and people are like wanting to get the money up, but it's like, we can only do 5% or we can only do 1% a quarter. So you're going to have to, there's going to be a queue for a while. And then you just have like, or if there's like we have a credit event in the market, what happens? Like, so like there's some ways that these things have not been tested, at least not some of the newer things. I think, we've certainly had, non-treated rates go back further. We've seen cycles with those. We've also seen other things happen with those, but like, I'm really curious to see what happens with private credit funds, when some of this stuff, comes to a head.
Yeah. And I think that goes back to, first and foremost, educating your client on, yes, there's quarterly liquidity now, but it doesn't mean there's always going to be quarterly liquidity. And so, luckily obviously not luckily, we've had some experiences with interval style funds that have taken a while to wind down and have been gated for periods at a time. And you do feel, I forget exactly what the kind of paradox is, but I think it's Zeno's lemma. I had a math teacher in college that exemplified this physically in the room. It was very funny, but it's basically if you walk halfway to the wall and then you walk halfway again, right, mathematically, you should never get there. Right. But the professor smacked his head against the wall to make the point, right? But But so when you're in one of these funds and you're only getting 50% of your commitment back every quarter when you request to redeem, it feels a little bit like that. And
Hmm.
so I think living through that with clients and also educating them at the beginning is just really, really helpful. But you've also got a bunch of other participants that may not have had that experience yet, and just saying like, oh, well, there's quarterly liquidity and there will always be quarterly liquidity. And so kind of rushing into and putting clients into some of these vehicles that may or may not have the ability to take on that illiquidity.
So for firms that, don't have the experience that you guys do with just the asset class and some of the stuff, what are some tips that you would just, broad market tips for like RAs that have not done a lot of alts and maybe thinking about it? Are there some pointers you would have for them without giving away any secret sauce, of course?
I don't think we do anything secret over here. I think it's just the basics of blocking and tackling and going through the suck. But no, I would say like the first thing is read. If they provide you with legal documents, read the legal documents. If they don't provide you with legal documents, ask for legal documents. And so maybe go the extra mile, spend the extra legal dollars to maybe talk to some external counsel to guide you through these things, because a lot of counsel will, fairly cheaply give you what their perception of market is and what's market and what's off market, because it's what they do on a day-to-day basis. And so they'll bring up things, and you may, read through the legal documents, have a list of questions. They'll read through the legal documents and have a list of questions and highlights to say, this is market, this is off market. Why don't they have X in here? Because you can read things and say, I don't like the way this reads. I don't like, what about this scenario? What about this scenario? But what you won't see is what's not in the document. And so they could come back and say, oh, well, it's very normal in the situation to have a GP removal clause. Why doesn't this fund have a GP removal clause? And if you don't have the experience of looking through hundreds of these documents, you won't say like, man, where's the GP removal clause? And so it's just spending the time to read through the details of the agreement, know what you're agreeing to, know what investor protections you have, and then also hopefully talking to somebody else to say, hey, what other investor protections should I have here? And what should I expect for bringing, XYZ capital to the table with a fund like this? And so doing all of those things, I think, is just first and foremost to, one, understand the economics of the investment you're getting in, but two, understanding the structure of the investment you're getting into, whether it's an interval fund or a private drawdown vehicle, is really, really kind of paramount to understanding what you're getting into. And then after that, I mean, it's really just you're not going to know everything, and so just going
Hmm.
in it with some humility
Hmm.
and preparing your clients for that, because like there's just delays in reporting, there's going to be delays in tax filings, and so preparing clients on the way in, and then just being humble when it happens, of saying, I thought I was going to get a K1 by June. I'm actually not going to get a K1 until mid-August. And it's because of X, Y, and Z with my accounting firm that I chose to hire for tax year or something like that. And then there's going to be delays getting quarterly capital account statements into your accounting systems and things like that. And so being prepared for delays and for hiccups is just going to be a natural course in these deals. And once again, I think it's part of the reason these opportunities exist and provide excess returns, is because not everybody can deal with that, with the complexity, go into it with humility, and especially the illiquidity.
I know it's going to be obviously contingent on clients, like their goals, their risk tolerances, all the kind of proper conversations that have to happen. But is there like a general range for like what kind of allocations that you are working in terms of, alternatives for the folks that are using them?
Yeah, and it's certainly predicated on, because obviously for our client base, right? Like if you're talking to a 25-year-old NFL player on their, ending their rookie contract, and signing their first big contract, and may have another big one after that, they have a much different time horizon than a person of similar wealth, that's in, maybe their mid to late 60s or 70s, right?
Right, right.
And so you want to take all of that into account, right? Future earnings when you're sizing things, and then liquidity needs, right? And then also total portfolio size. And so that's a lot of variables that you're
Sure.
trying to melt down. But once the advisor, and they talk to people on my team all the time about these things, is like once they have a general idea, the first step is to just sit down with the client and say, hey, I think you could have 15% of your portfolio in illiquid style private markets opportunities. Are you comfortable with taking 15% of your portfolio? And it's not going to be tomorrow. It's not even going to be next year. It's going to take us a couple of years to build up to 15% as we source the opportunities. But once we get there, are you comfortable with, if you have $5 to $10 million, are you comfortable with that number not being available for you to just withdraw at a moment's notice? And having that very frank conversation with the client. And then as that number starts to go up, or their experience with alternatives may go up, I think they get a little more comfortable with those things. And so once you get there, then you can say, all right, well, we were comfortable with 15. We met our 15 goal over 3 to 4 years by making these commitments and having these drawdowns. Maybe the portfolio's grown some too. Are we comfortable now at maybe 20% or 25? I mean, some of our largest clients are truly have multi-generational wealth and are
Mm-hmm.
investing much more like a foundation or an endowment
Right. Like, yeah.
than a traditional high net worth client would. But we're still trying to provide the tools for our advisors to make that decision for a $5 million client the same way they would make the decision for a $750 million client. And that really comes down to client comfort and education, but then also the tools to say, all right, if I'm building a 5% allocation to private equity, how do I make commitments today? How do I make commitments next year? And how do I make commitments the year after that? And then how do we reassess them along the way to see where distributions are coming back? What's the size of the commitments we just made to manage that expectation? And then the biggest thing, I think, is to really understand with that advisor and with that client to understand that, hey, the market's probably going to have a drawdown
Mm-hmm.
across, not probably, 99% probability we'll face a drawdown here. And so just because we're targeting 5% doesn't mean if the S&P drops 20 that now all of a sudden we have 7.5% of our portfolio in private equity, because we, most likely those marks aren't going to move as much.
Right.
And
Right.
so just being ready for that and having that flexibility, and just really trying to educate with as much as you can, because you can talk till you're blue in the face, but until a client experiences it firsthand, you get a very different reaction when it's real and right in front of them. And so doing as much as you can on the education front going in, and then also being ready for, all right, we're working through a broad market drawdown right now. We're also working with our investment partners to figure out where everything is, but we also have to take that time to provide like the hand holding and the reassurance that, hey, things are still going just fine. This isn't a time to panic and try to go sell something on the secondaries market or something like that. So it's certainly a lot of education.
Yeah. Yeah. Well, Ben, I appreciate, we've gone for a good stretch here. So probably good place to end things. But before we wrap up, just wanted to, if there's any like final thoughts or things that I didn't ask that you would want to just share with the audience. And secondly, if folks want more information about MAI or about how to reach you, if you want to address either or both of those things.
Sure. I would say the only final thought is, like the old investment adage of there's no free lunch,
Mm-hmm.
and so I don't want people to think that just because you have access to alternatives now that excess returns will just magically appear. There's no replacement for doing the work, finding good underlying investments and finding good structures for those investments. And so I'm not worried about my job or my team's job going away anytime soon, because there's still a lot of work involved. And so, don't just run out and buy the first alternative investment you see. Go out and do the work and survey the market and try to find the best opportunities for your clients. And then, yeah, if people want more information on MAI, you can go to our website at mai.capital. And then if you'd like to reach me, I'm on LinkedIn, and you can shoot me a message.
Okay. Well, David, if people have questions for you, how do they go about doing that?
LinkedIn's probably the best way to reach out to me. So just, connect, send me a message there. Also, just make sure to be, if you're picking up this podcast on one of the services, make sure you come to our website, wealthmanagement.com, check out our investment section where we have lots of additional coverage of not just alternative investments, but SMAs, model portfolios, all the tools that advisors are using for managing clients' investments these days.
Okay, well, thanks to both of you, and thank you for listening today. Please like, follow, and share this podcast with your friends. Until next time, I'm Wendy McConnell.